This is SFNet Presents In the Know with host Barry Bobrow, sponsored by Hilco Global.
Welcome everyone to the podcast series SFNet Presents In the Know with Barry Bobrow. For those of you who don't know me, I'm Barry Bobrow. I've spent the past 37 years working in banking, most of it in debt capital markets, and most of that in leveraged loans. I've managed highly successful loan syndication teams at several large banks. I've also been very engaged in the asset-based lending market, and for many years have been in a leadership position in the primary trade association for asset-based lending, the Secured Finance Network. I really want to thank the entire team at SFNet for all of their support in making the In the Know podcasts a reality. My work in asset-based lending led me to originate a conference with the Secured Finance Network, known as Asset-Based Capital, or ABCC, now in its 16th year. ABCC is not about asset-based lending, but rather is focused on the important insight and perspectives that participants in and around the asset-based lending market want and need to know about. The topics we cover have broad appeal to everyone who's engaged in the secured lending market. The In the Know podcasts will be in the same spirit as ABCC. I'll be bringing you a series of conversations with thought leaders on important topics impacting secured lending. These brief but engaging discussions will give you insight and perspectives critical to being more successful in your businesses by keeping you in the know. Before I begin, I want to thank you for watching and listening, and to let you know that SFNet and I both welcome your feedback on today's discussion, as well as your suggestions for future topics and speakers. Today's podcast is dedicated to the direct lending market, a critical topic for anyone involved in asset-based lending for several reasons. First and foremost, is because of the high degree of integration between asset-based and related debt markets. Without the ability to access other debt markets to fill in the remainder of the capital structure, many asset-based loans simply couldn't happen. That applies to acquisitions, refinancings, and restructurings. Second, is that the direct lending market is both a competitor and a collaborator to the asset-based market. Understanding the liquidity, credit, and return issues in private debt are critical to the asset-based lenders trying to understand how to successfully generate and execute transactions. Lastly, the relative attractiveness of private debt versus broadly syndicated debt is something that will impact capital structures in future transactions, particularly given the changing market dynamics in the current environment. My guest today is my good friend, Randy Schwimmer. Senior Managing Director, I'm going to make sure I get this right, Randy. Senior Managing Director, Co-Head of Senior Lending at Churchill Asset Management, LLC, and founder, the most important part, founder and publisher of The Lead Left. I've known Randy for longer than either one of us cares to talk about. And I've really watched with great interest as he has turned his passion, which is talking markets, into his profession, working for Churchill, and really via The Lead Left. Randy is the authoritative source for information. That's how I view it anyway. The authoritative source for information on middle market leverage lending. And Randy, thank you so much for joining today. So let's start.
Barry, it's great to be with you. I'm honored to be, I think, your first guest on
victim
on the Barry Bobrow show. So thank you so much for that. And I was actually counting the years. So we started together in 1993. The desk at JP Chase. So that's a relationship almost going back 30 years. And since I've only been married for 15, I consider you to be pretty closest family.
Oh, that's great. Thanks, Randy. So, Randy, I did my best to talk about The Lead Left and how I think about it. Why don't you tell us a little bit about Churchill and The Lead Left before we start?
So I was actually an English major in college, and I liked to write. And it turned out that passion has served me well being in the middle market for my entire career, because the middle market historically was less of a transparent market. These were smaller deals, Barry, as you remember, that we would work on companies that were unrated, their loans didn't trade, and trying to explain how the middle market worked, who bought the loans, who financed the companies, who was involved in these rather esoteric kinds of strategies required some explanation. And so I decided pretty early on in my career to be out there talking about the middle market, what it is, how it works, and really how it works relative to the public markets. Little did I know, 40 years later, that you and I be sitting here talking about an asset class which today has been estimated to be around $1 trillion as a total universe, private credit total, including direct lending and venture capital and subordinated debt and other things. But it's now rivaling the broadly syndicated market. So, and frankly, high yield bonds. So, where Churchill fits into all this. So we've been doing direct lending since 2006. We started actually as a portfolio company of a private equity firm, and in 2015 we came over to the TIAA platform, which then merged soon after with Nuveen, which is a multi-billion-dollar asset manager. Today, the total assets under management of our parent company is probably about 1.3 trillion. And they have about 250 billion dedicated to alternatives, which over the last 5 to 7 years has been an increasingly interesting asset class to be literally an alternative to public equities, fixed income, and so forth. And it was thought by the parent company at the time that we started with them as their direct lender, that it would be an interesting alternative, frankly, for their investors. And here we are 7 years later, having raised a significant amount of capital. We are now 40 billion in size from a capital perspective, and we essentially do private capital. So we do senior debt, we do junior capital, we do co-investing of equity, and we actually have a significant business as a direct LP in the private equity funds whose portfolio companies we finance. So we actually are a client to those sponsors.
That's
so
right.
We get treated pretty well. So the lead left has been kind of our thought leadership piece. I've been writing the lead left itself since March of 2008. I started it because markets started to get a little choppy. Does that sound familiar, Barry? Markets started to get a little choppy, and our investors in those days, including our sponsor clients, were asking, what's happening out there? And so I started writing this piece, which has now grown today to be distributed to about 50,000 subscribers, including private equity, private credit bankers, M&A specialists, and so forth. So it's pretty widely read. And the thing that's cool about it is that we have about a dozen different content partners, like S&P LCD and Refinitiv LPC and DLD Direct Lending group that publish a lot of stuff. We also have partnerships with PitchBook and Private Debt Investor. And so if you go on the website, and any friend of Barry's is going to be will get free access to the lead left. So
you heard it here, folks.
Send me an email at Randy Schwimmer, Randy.Schwimmer at Churchill AM or theleadleft.com, and just say that you're an FOB, a friend of Barry's, and you will get free access. So that content comes in, and there's really no place on earth that you can go to get all of this information in one place. So we're pretty proud of it. But look, you've been in this business as long as I have. This is a time where people need direction, right? I mean, that's why this podcast is so exciting, because you and I can just talk freely about what's going on.
So let's back it up. So with all of that as preamble, we've got inflation, supply chain issues, negative sentiment from both consumers as well as CEOs, corporations, analysts. There's just a lot of information for markets to digest where we are right now. Where are we from your perspective?
I have been absorbing every piece of information that I can get my hands on, from economists to journalists who write good things about this, to other lenders, frankly, and talking a lot about what's going on. Two things. One is we know that we're in a bit of a battle, a race for time right now, with the Fed being at kind of a 1.5%, 1.75, wherever Fed funds is, after having just jacked up rates by 75 basis points. And that's apparently the most they've ever raised at one point, at one session.
In a long time, that's right.
Since '94. So they're in a bit of a race because inflation, the May numbers just came out for last Friday, 8.6% or something like that, the highest since, for 40 years, 81, something like that. So I think that race is clearly ultimately going to be won by the Fed, right? The question is, how long will it take? And in raising rates, will they trigger a recession? And so you're seeing in the markets continuing today this concern that this will end badly in a hard landing and that the Fed will have to raise rates so rapidly and at such a high level that it will cause a recession. So that's what you're seeing in the market right now. Now, the financing markets, let's take all three of them, the high yield bond market, that pretty much has been shut down over the last month or two. Primary issuance kind of came to a grinding halt. And, they're doing a few deals out there, but for the most part, it's a market that's been shut down. The leveraged loan market has continued. But what happened there was that because it's a traded market, it's a liquid market, the secondary loan market, the prices that were being reflected in that market over the last couple months, which were starting, say, before the Ukraine Russia crisis started at, say, 98, 98 and a half, traded down to kind of 95 level on average. And in some cases, with some businesses that were more cyclical, in order to get those deals done, they had to price them down to, the 80s in order to get them sold. And the result of that was that the overall yields in the leveraged loan market has spiked. So, 3, 4, 5 months ago, they were, 4%. You could get a strong single B done in the leveraged loan market for a kind of a 4%, close to 5% yield maybe. Today, it's more like 8%, right? Now, if you contrast that with the third market, which is the private credit market, which doesn't trade, and therefore is less correlated to what's going on in terms of headline risk, we're pretty much priced about where we've been. Now, in some cases, you've seen deals getting done 25 basis points wide or maybe 50 basis points at most wide of where they were done kind of pre-crisis. But for the most part, because the capital that's being provided by the participants such as ourselves in direct lending is locked in, both our assets and liabilities are locked in long term. We have LPs ourselves. And these LPs have committed to a variety of funds, in Churchill's case, CLOs, BDCs, separate managed accounts, commingled funds that all have long-term lockup periods. And so we have the ability to go out during times of crisis and commit to financings and hold significant amounts of capital. We can hold $300, $400, $500 million per deal and not have that be over a $40 billion portfolio, not have that represent any kind of concentration risk. And
yeah, Randy, it's interesting because you've got a different supply and demand dynamics in the broadly traded markets versus private. And maybe for the first time that I remember, there was always a pricing premium in the direct lending business, and maybe a little bit more structure. But it feels like so much money has been raised that they're really, if not on top of each other, probably more attractive in the direct lending market today.
Right. And so what's ironic, Barry, about this period is that over the last 7 years, we've had a number of investors who, including our parent company, who has sought more exposure to private credit because it's less correlated. And now we're in a period where, some investors are looking at these headlines and coming to us and saying, why are you trading lower than the broadly syndicated market? And I have to explain, because we are less correlated. That is part of the challenge. And so going to the other part of your question, if you're looking at opportunities in the broadly syndicated market right now at, say, 8% yield or even higher, there is an attractiveness to that, right? I mean, there's no question relative to the much more stable direct lending market. And in fact, going back to 08, 09, when we had a broadly syndicated capability within Churchill, today it's in the Nuveen business, but in those days, we looked at the leveraged loan market and we actually took opportunities to buy some paper in that immediately early 2010 period. The problem was, we may have bought $300-400 million of heavily discounted, strong single B paper. And the problem is it didn't last. That trade didn't last because liquidity came into the market as the Fed, injected more liquidity. And, by March or April of 2010, the trade was gone. And so I suspect the same thing will happen in this current market. we're seeing some opportunities to buy assets right now, but my guess is that it won't last. And that's the problem with using the BSL market as a strategy to buy at a discounted, to buy these discounted deals. It's very hard to scale that. Now, in our market, on the other hand, we will basically be doing the same kind of, call it 7 to 8% yielding paper, the same paper we've been doing for the last 15 years. We're going to continue doing through this crisis with very good private equity sponsors. So all the loans that we do and all the junior capital that we provide. So we do, all four classes of capital, as I mentioned, up and down the balance sheet. All of that is with private equity-backed companies. So, they're looking to put money to work in this market. And you've dealt with PE firms. They've got dry powder they need to deploy.
But let's go over there for a second. So, hundreds of billions of dollars of so-called dry powder. I've seen different estimates, but approaching $1 trillion. And yet M&A volume is off 75% year over year or thereabouts right now because of a variety of factors. First of all, it's harder to price a deal when you don't know what the EBITDA is, so you have to make a bet on the economic environment. But secondly, I think you have sellers whose expectations are probably based to a large extent on where their stock was trading, a number of months ago, and now it's down substantially. So it's harder to get the deal to come together. So how will private equity deploy all that money that's sitting there? They don't want to give it back, I'm sure.
Yeah. So what's happening, as you might imagine, given those dynamics, is that for the businesses that these sponsors are interested in, purchase price multiples are not going down. And it'll be interesting to see, Barry, if we get into a period of more of a systemic recession, and it's still, I think, less than 50% that's going to happen. And even if we have some kind of recession or downturn or slowdown, I think it's going to be shallow. But even if we get into a real one, the dynamics of private equity sponsors, certainly with the sectors that we focus on, so more defensive businesses like healthcare, technology, software, distribution companies, specialty in industrials or manufacturing, anything really that has been thriving over the last 3 or 4 years is probably going to continue to thrive in this environment. If you made it through COVID, as we did on the portfolio side without having any hiccups, as a private equity firm, you're going to continue that trade. And what we're seeing anecdotally, Barry, is that the properties that sponsors are focused on buying are not going cheaper. They're actually going for higher purchase price multiples. Like we just saw a deal with a client who we thought was going to win the transaction at an 18 times multiple, okay? Just to give you a sense. And this is a relatively small company, but it was a really good company. And they lost it to another sponsor that paid 28 times, okay? Now, that just sounds completely crazy, right? But if you're a private equity sponsor that has significant capital, that's looking to make realizations, that's on fund number 6, that wants to raise fund number 7 beginning in September, has to make one more acquisition, they've got an opportunity to do that, they figure, okay, if I overpay a little bit, that's okay. I'll put some add-on acquisitions to the platform to sort of blend down my overall purchase price multiple, and I'll be okay 5 years from now. That's what they're thinking. Will that work? Who knows? But if that dynamic continues, now, me as a senior debt lender, that's great for me. That's great news because I got all this cash equity below me. But it'll be interesting to your point, whether or not the private equity multiples are going to continue to go up in this environment versus the public market multiples, which are clearly not.
Randy, one of the big differences, I think, between where we are now and maybe the last recession, which lasted about 2 days, and it was in the early stages of the pandemic, is at that point in time, the government, not just our government, but governments around the world, had a few more bullets in their chamber to use, and they did. They deployed substantial easing and government money coming in, which kind of leads us to where we are now. But in the current environment, the Fed is trying to tamp down inflation, which means it won't, if it does result in recession, it will not be as quick to try to solve the recession with additional liquidity. But that to me means you've got distress in companies that we just haven't seen in a long time. How do you think that the direct lending, the private debt market reacts to that situation versus the broadly syndicated market?
So these are very different markets in the mechanics of the way they handle portfolios. And we're doing a special edition of The Lead Left starting this week, actually, on portfolio construction, because we're getting that exact same question from investors. And what's interesting about how the BSL market works, as you know, is that it's comprised of industry specialists in different sectors, so gaming, entertainment, aerospace, and so forth, as well as housing and manufacturing, industrials. And the result of that, including energy, frankly, and natural resources and commodities and other cyclicals. But the difference in the large cap market is that these are specialists who understand and focus on the very large public issuers of credit. So these are businesses that have been around for a long, long time, hundreds of millions of dollars of EBITDA, significant critical mass. And the way that they manage portfolios is, they understand over decades the behavior of these very large companies through a number of business cycles. Plus, these loans and the bonds are all liquid. So if there's an issue with some of these companies, the portfolio managers can trade in and out. And that's what you're seeing right now, mostly trading out, but there's definitely profit taking as well. In the direct lending market, you can't trade in and out because they're illiquid, they're not rated. These are small loans. It's really a buy and hold strategy. So for direct lenders like ourselves, we know once we do the deal and we own the loan, we own it for a long period of time. So what we want to make sure of, we can't trade out of it if there's a problem. So we have to pick sectors that we believe over long periods of time will be okay. And that's why I mentioned the healthcare and defensive sectors like technology and software. And the result of that was that when we went into COVID, and by the way, we didn't know COVID was coming. And that's the difference between the current crisis and
that's
crisis
true.
2 years ago. You remember, you probably left your office, Barry, that Friday, March 8th or whatever it was, thinking, oh, I'm not even going to have to water my plants.
That's right. That's right.
A couple of weeks. And, a couple of years, later, you come back. And so.
But plants are not doing very well.
No, mine aren't either. But what's interesting now is that we've been seeing this inflation crisis building for at least a year. And now that it's happening, people are freaking out, even though actually what's happening is good news because the Fed is tackling it. And by the way, I do think that inflation is starting to come down, but it's at such high levels right now that it's not going to come down as quickly as people thought. So I think that for direct lenders such as ourselves, when we make a bet on a portfolio company, and it's not a bet, it's a very well considered and thoughtful underwriting with a private equity sponsor backing it that we trust and invest with, we know that we're stuck with that loan for a long time. And so the result of that is that for direct lenders, the commitment that they make to both the borrower and to the private equity sponsor involves a partnership. And that partnership is one of the reasons over time, and you've seen these figures, that the smaller loans actually do better in terms of defaults and losses than the larger ones because of that collaboration between the small lender groups who are all buy and hold, and therefore they want to cooperate with the sponsor, and the sponsor who owns the business and doesn't want their value to go to zero, and so they're willing to do whatever they need to do to fix the problem. In the BSL market, it's more challenging because you have lenders who may have bought into the loan at 50 cents on the dollar,
right?
Because it was trading at 50 cents, and all they care is getting out at 60 or 70 or 80, not getting out at par, which, for those of us who go in at 98 or 99, getting out at par is critical. So I think the dynamics are very different, which I believe speaks to the benefits of the asset class through difficult times as we're seeing right now. It's just the optics of seeing where prices are going that make it a little bit less palatable.
Randy, our time is almost over, and I wanted to give you one more different question because you've just completed a lengthy series on ESG, and just actually right around the same time that you completed it, there seems to have been a number of things written around some of the perils of ESG not done well. Some of the regulators are focusing more on it. I wonder if you want to give us kind of a postscript on that.
Thank you for that question. And again, for FOBs, Friends of Barry. We're going to make both that special series and all the ones we're doing free to you. So that series, which we called Why ESG Matters, I did in part because investors were asking for it, and a lot of investors wanted to know not only what Churchill was doing, what Nuveen was doing as a leader in the ESG space, but also, what's going on that we should know about. And so, and to be honest, Barry, I didn't know a lot about ESG other than, environmental, social governance. In fact, I'm not even sure I knew that it was social and governance. I knew environmental. But I started doing a lot of reading, a lot of homework, talking to experts as we do, frankly, a lot at the lead left. And actually, we featured you several times, Barry, when we were talking about asset-based lending. I went to the master for that. So with ESG, what I learned was two things. One, there is a long history not only in the United States, but in the world regarding sensitivity about things in the environment, things with regard to how people are treated, and also how companies are managed. And in each of those situations, you can trace back many, many years, threads of events that have made what we're now looking at as something called ESG really, really important. So this did not just arise because some regulator said, hey, you need to do this, or even some investors saying you need to do that. This has come after decades, and in some cases, centuries of development and concern over how we treat the planet, how we treat each other, and how we treat our sort of communal organizations. Perfect example on environment is something that you may remember in the 1970s, the ozone, the hole in the ozone layer, right? And this scientists were alarmed because I think it was above the North Pole, where the ozone layer was thinnest, it started to evaporate. They didn't know why, and they traced it to a significant amount of fluorocarbons, which they traced to spray cans for hairspray, which of course I don't use anymore. But at the time, we didn't understand it, but they banned fluorocarbons, and guess what? The ozone layer repaired itself. It was a small example of how we saw that crisis in climate or in the environment when we fixed it as a result of human action and human intervention. So there are ways that we can fix these things. What's happened today, to your point, is it's become political. And the regulators have stepped in a big way. Politicians have stepped in a big way. Sovereign countries have stepped in a big way. And the result of that has been real concern about how you measure whether or not you're being green or green friendly or environmentally friendly. And people are discovering it's very hard, number one, to measure this stuff. And number two, you're finding as a result of some of the things in the news is that some organizations have been accused of so-called greenwashing, saying, hey, our fund is green when it really isn't. And so you're seeing a clampdown on this. Now, the problem is people are therefore throwing the baby out with the bathwater. They're basically saying, oh, well, somebody's cheating, and so therefore ESG doesn't make any sense. The reality is it does make sense. There's real reasons to do it. And I think if you start to look at some of the benefits to companies that actually treat people well, treat the environment well, and run their companies well, that those businesses over time will thrive. And the businesses that don't treat their people well, don't treat the environment well, and don't manage their companies well will not thrive. That's generally the thesis. Mm-hmm. But I do think that over time, the more scrutiny and the more, frankly, skepticism on ESG, the better, because what will happen is the authentic nature of what we're trying to do, we as human beings in terms of investing and growing businesses will come out. And actually, we have a partnership with Kohlberg Capital, which is one of the top private equity firms in the country, to go out to other private equity firms with a template, basically saying, hey, as you guys think about your investments, characterize the various elements of ESG using a template like this. And I think the more traction we get on that kind of thing, where private equity firms who, as you know, provide significant amount of growth to the middle market and therefore to to the country, I think that could be a real game changer long term. So it's something that we're going to continue to write about and think about.
Yeah.
Looking forward to publishing more stuff, and I'd love to down the road talk to you more about that as a topic. I think it's an important one.
Yeah, well, thanks for that. We're out of time, and since you offered up a free subscription to everybody that listens to this, I hope that they take you up on that and listen in particular to your recent series on ESG, which I thought was really thoughtful, really well done. Randy, it's great to see you, and thanks so much for joining us for the inaugural edition of In the Know with Barry Bobrow, and I'm sure we'll talk again soon.
Thanks, Barry. It's been a treat and a pleasure.
I think Randy hit on three very important themes in his remarks today. First is that the private debt market is much more functional, predictable, and attractive than the broadly syndicated market for bonds and institutional term loans in today's world. It's therefore expanding at a very rapid rate. This appears to be the landscape for the foreseeable future, given the underlying causes of the disruption to the public markets. Second is that when restructurings occur, as they inevitably will, the perspective of a direct lender will be very different from that of the broadly syndicated markets because of the lack of a liquid secondary market. This means that the same direct lenders making the initial loan are much more likely to be involved in any workout or restructuring activity versus the investors in a broadly syndicated loan. Lastly, Randy's comments on ESG are important to consider, and I encourage everyone to take Randy up on his offer to become subscribers to the Lead Left and listen to his recent series on ESG. We're in the infancy of ESG, and while it may be difficult to predict the definitions of ESG loans and the speed of transformation, the path seems plain, and it's something we should all become more knowledgeable about as soon as we can. I'd like to close with a special thank you to Hilco for sponsoring the In the Know podcast with me, your host, Barry Bobrow.